Hello everyone and welcome to Accounting Education channel. Today we'll be talking about balance sheet and we'll go through detailed example at the end. So what is balance sheet? Balance sheet is one of the three main financial statements. First one is income statement, which is provide idea about the business performance and how much profit they are generating during period of time. Second one is the balance sheet, which is showing a snapshot of the financial position of the business at a specific point of time, and we'll be talking more detail about it in this video. Last one is the cash flow statement, which is showing how the company is managing its cash and how it's generated and where it's being expensed. Why we need financial statements? Financial statements are part of accounting system. Accounting system is used to record, sort, analyze, and report the financial data. The most famous generated reports are called financial statements, which provide information about the business financial performance from different angles. All the three are important and correlated with each other. The purpose of those reports is to provide the user about all the required information to make more informed decision, and of course still analysis will be required to be done. Any company want to list its share in official stock market, it should provide regular financial statements. Now let's start exploring more details about balance sheet. Balance sheet is also called statement of financial position. So as the name implies, it provides insight about the financial information related to the business in terms of what it owns and what it owes. What the company owns is the company resources and it's called in accounting assets. And what the company owes, it can be either the money the owner of the business put into the business, which is called shareholder capital, or money from third party like a loan, which is called liabilities. One more piece of information we can link into the name. What the company owns is equal to what the company owes. This is the accounting equation, which is the backbone of the double entry accounting system. And this is also will guarantee the balance between both sides. We know the following fundamental points. In order for money to show in one account, it has to come from another. It will not just appear or disappear. And whatever the business has as resource, it came from specific source of funding. To understand it further, let's assume that you want to buy a car. You'll be having two options. Either you can use your own cash or you can get a loan. And same thing applies for business. One important point is that balance sheet is providing a snapshot of what the business owns and owes at a specific point of time. Let's go back to our car example and see that you had 20,000 cash and today you bought your car. So if you'll say that balance sheet as of yesterday, you will say that you are having 20,000 cash, and if you'll say balance sheet as of today, you will say that you are having car. You cannot say that you are having cash and you are having the car as well. Because balance sheet is not covering period of time, it's provide information relevant to a specific date. And here where it's vary from income statement, that income statement provide information about business performance over a period of time, which is usually month or year, so it will give the full data related to that month or year. Now let's start looking at balance sheet components. We're having three main components: assets, liabilities, and equity. Assets are the business resources and it can be segregated into two parts, current and non-current. Liabilities are the money owed to third party and also can be segregated to current and non-current. Equity is the shareholder money, which contains capital and retained earnings. Assets represent what the business owns, and both liabilities and equity represent what the business owes. We'll be looking into more details later on. However, it's good to refer to this slide for summarized information. Now let's try to bring the accounting equation formula to the next level. What the business owns is equal to what the business owes, which means asset, the business resources, is equal to equity, shareholder money, plus liabilities, money owed to third party. We'll not be talking further about accounting equation in this video, as there is separate video for accounting equation which has a lot of useful information, and I really recommend that you watch that video as it has full walkthrough from the beginning till the end, along with different transactions and what is the impact of those transactions. Now let's talk about assets. Assets are the valuable resources of the company. They represent future cash inflow, which means that whenever you're having asset, the company can guarantee that in the future will receive cash against this asset. Asset can be classified into two types, non-current asset and current asset. Non-current asset is long-term in nature, which means that it has useful life for more than 1 year and it serves the long-term of the requirement of the company. One more feature about non-current asset that it's difficult to be converted to cash, which means that it will take time to find buyer and sell it at the fair price. Examples: vehicles, building, and long-term investment. In the other hand, current asset is short-term in nature, which means that it has useful life of less than 1 year and it serves the short-term requirement of the company, which is mainly the day-to-day transactions, and it's also easy to be converted to cash. If we'll take example for this, we are having cash, inventory, and account receivable. Liability, we can say about it that it's opposite to asset. It's money owed to third party or financial obligation of the company. Represent future cash outflow, which means whenever there is liability, there will be money to be paid in the future. And it's also classified into two types, non-current and current. Non-current liabilities is long-term in nature, which means that the obligation to be settled in more than 1 year. And the most famous example for it is long-term loan. Current liabilities is short-term in nature, the obligation to be settled in less than 1 year. An example for it, dividend payable and account payable. One important point the business should be careful about is the balance between the current liabilities and current asset and non-current liabilities and non-current asset. It should be managed in a way that the majority of current liability can be settled using current asset, so the day-to-day transaction can run smooth without any interruption. Last part in the balance sheet is the equity, which is the shareholder remaining money after liquidating all the assets and paying off all the company debts. Equity consists of two parts: shareholder capital, which is the money paid by shareholder into the business, and return earning, which represent the cumulative profit that kept aside or retained for future use and not paid as dividend. So equity usually grows with the business growth with the profit. However, if the business is making loss, the equity will go down. By this, we almost covered everything about balance sheet, and now we'll be looking into the detailed example. This is simple example of balance sheet, and for company called XYZ. The balance sheet is as at March 31st, which means the balance sheet was done as of the date of 31st of March. Now we can see that balance sheet is divided into two main sections, one for asset and one for liabilities and equity. Asset is also divided into two, non-current asset and current asset, and second section is divided into current liabilities, non-current liabilities, and equity. When we say balance sheet is balanced, what we mean is total asset should match with total liabilities and shareholder equity. These two total here should match with each other 100%. We put one checkpoint. This checkpoint is taking the difference between both totals, and the checkpoint should be 0 all the time. Let's start exploring some different scenarios of our business. And our first scenario is customer make a payment for all invoice worth of 50,000. So we're having one of our customers who paid us invoice, and the value of the invoice is 50,000. This transaction is going to impact two accounts. One account is account receivable and the other account is cash. Account receivable will be going down by 50,000, so I have to credit my account receivable by 50,000 and it's going to be 100,000. The same time cash will be increasing by 50,000, so I have to debit my cash by 50,000, and 75,000 of cash is going to become 125,000. Now we can notice as well that asset or total asset did not change, because 50,000 went from one asset account to another asset account, and we're done from recording this transaction, and we can see that we don't have any error in our check, and the check is showing 0. Let's look at our second example. Our second example is saying Company purchased some goods with value of 40,000 in credit. So we have made purchase of some supplies. The value of the supplies is 40,000. Purchase was done on credit, so no cash got involved. This transaction again is going to impact two accounts. One account is inventory, and the second account is account payable. The supplies worth value of 40,000, so inventory will increase by 40,000. So I have to debit my inventory by 40,000, and it's becoming 340. At the same time, I'll increase my account payable, so I'll credit my account payable by 40,000, and 250,000 of account payable is going to become 290,000. And by this, we're done from recording our second transaction. Our third and last example. This example is a little bit advanced compared to previous two because we'll show us the link between income statement and balance sheet. And before we start, I just want to highlight that I split the equity between owner equity or money invested and return earning, which is the accumulated profits. Our third example is saying company made a sales of 130,000 using inventory worth of 100,000 on a credit. This transaction is having different sections, so let's start looking at the first section. Company made sales of 130,000, which done on credit. So I'll increase the account receivable by 130,000. I'll debit account receivable by 130,000. It's going to become 230. The second part of this transaction is going to be the sales. So I'll start work out the income statement, and I'll register the sales of 130,000. Now let's start looking at our second section. Second section is between inventory and cost of sales. So inventory worth of 100,000, I reduce the inventory by 100,000. So I'll credit the inventory 100,000, and it's going to become 240. At the same time, I'll register cost of sales of 100,000. And we will be left only with one section which is related to profit. So I'll start calculating the profit. 130,000 minus 100 is going to become 30,000. And this profit is going to move to return earning, which we said that this is the accumulated profit. So 100,000 is going to become 130,000. And we're done from our third and last example. If you are having any area which you want me to explain it further, mention it in your comments and I will get back to you as soon as possible. If you like this video, press thumb up and subscribe to the channel so you will not miss similar videos.